So I'm watching this video on YouTube, and I heard the Forex guru explain that there is a lot of liquidity sitting at the bottom here. And that is why when the market moves to that level, it sucks up all the liquidity and move away. I'm like, what? What did he just say? Good afternoon, traders. My name is Daniel Mangal. And in the next 10, 15 minutes, I'll be explaining to you what liquidity is and what that I just explained to you is pure nonsense. I'm also inviting you to join our live trading session. It has been going on for 2 weeks already, but still 2 days remaining. That is Thursday and Friday. Today is Wednesday. You might not be able to join us this afternoon because you wouldn't see this video. But when you do see this video, I really like you to join us. You will see how we actually trade. Now let's go back to the topic. What is liquidity? Let's Google it. And let's see. When you Google it, this is what you get. Liquidity is companies' ability to convert assets to cash or acquire cash through a loan or money in the bank. That's it. That's what liquidity is. So let's go back to the video. What did the guy say? He said liquidity is sitting at the bottom here. Cash is sitting at the bottom there. Really? And this guy had thousands of followers. So what I did is I go to YouTube, I put the search liquidity, and there are thousands of videos out there telling you about this liquidity strategy. And they're all telling you about liquidity gaps, liquidity pools, liquidity areas. And I'm like, what are these guys talking about? Liquidity simple means cash. You have liquid cash. If you're a business, you have cash to run your business, so you don't go out of business. If you're a broker, all it means is that you have cash to run your business as a broker. So if I'm to buy something, you will take the order on the other side of the trade. You will sell it to me. So if I said I would like to buy 1 million euro worth of dollar, you have $1 million to give me. Right? Basically, that's all it's saying, that you will take the other side of the trade. Now, some brokers do have their own capital and they're capable of doing that. And some brokers do not have their capital and they go to liquidity providers. That could be a bank or many banks or companies that provide liquidity for brokers. There are companies like that. So all these companies are saying, or these banks are saying to the broker with the contract they have, is that it doesn't matter at what price, at any given price, literally any given price at any given place in this chart, whether it's here, it's here, it's here, anywhere, any trader, any of your trader takes a buy or a sell position, we will take the other side of the position. Now, that doesn't mean that they're going and buy that money for you, or they're actually going to make a trade for you. So when you said, I like to buy 1 million euro, they're going to buy 1 million euro for you. That's not what they do. What they're saying is, because it's CFDs, contract for difference, is that if he is bet that euro is going to go up, we will take the bet that euro is not going up. Now, when he decides to close the bet, when you do close your trades, there is a difference in price. Either you win or you lose. If you win, they pay you. If you lose, you pay them from your capital that you have. And you also have a capital that you're trading with. You see? That is all there is to it. And that is why they need liquidity. There's not a reason. Most times your broker don't even give your trade to anybody. If you have a $5,000 account, $10,000 account, or $1,000, your broker is not setting that trade anywhere. He just keeps it in his books. And he's hoping you're going to lose. The stats have told him, if he followed the stats generally, is that 90% of you will lose anywhere. And that means that money will go to him. That's all. And he is literally banking on you losing and you paying him all the time. Now, if any guru, any mentor, any Forex trader out there tell you that liquidity is sitting here, he is displaying a vast amount of ignorance of the market. He's literally telling you, I have no idea what Forex trading is about. I don't know what liquidity is. I don't know what liquidity providers are. I don't know how the market moves. And that is why I believe there is cash sitting at the bottom here. That's crazy. I remember watching another one and the guy said, well, they're coming into a liquidity area. I'm like, what? What are these guys talking about? What do you mean it's coming into a liquidity area? There is no area of liquidity. Liquidity is cash. And the broker always has liquidity, because if he doesn't, he is going to go bankrupt. I think we all heard of the broker, the crypto broker who go bankrupt. Now, I'm not going to call the name in my webinar. I don't want liabilities. I don't know why they went bankrupt, but from what we understand is they borrowed too much money, they spent it, they can't pay back, and they don't have liquidity to manage it, which means they don't have cash to manage their daily trades. So if you go and you buy something, they don't have the money to pay you. They don't have the money to take the other end of the trades. And they don't have liquidity to even maintain their business, because the banks are saying, no, we're not giving you loans. And since they have assets that they would like to sell, they have what you call non-liquid assets. You see, liquidity is your ability to convert assets into cash. How fast you can do that, that means your business is very liquid. If you can't do that, your business is not liquid. So their business is not liquid because they were trying to sell it to Binance. And Binance said, oh, no, sorry, we're not buying. We're not even touching that. That thing is toxic. We're not even touching it. So what happens? They go bankrupt. They file for bankruptcy. That is what liquidity is about. You're talking about a billion-dollar company, a multi-billion-dollar company that went bankrupt because it's not liquid. It doesn't mean they don't have money. They still have a lot of assets. They still have a lot of investments. But those are not liquid investments that they have. They have to pay loans. They have to pay interest on loans. They have to pay workers. They have to pay a lot of money all over. And they don't have the liquid cash to do it. And when they try to sell their asset that they have, the people they try to sell it to, which is Binance, said, nope, we're not buying. So if you can't sell the asset you have and you don't have cash to run your business, you go bankrupt. That's liquidity. It has nothing to do with any part of the chart. It doesn't mean liquidity is sitting here or they're moving into liquidity area or there's a liquidity pool here. All of that is BS. Any video you watch and you hear that in, you have to run the opposite direction. Close that video and run, because that is BS. What that is telling you is that that person making the video has no idea what he's talking about. And he's too lazy to go Google it. Because had he done his research and checked what liquidity actually is, he would not make a video like that. It would be too shameful to make a video like that. Because you're displaying a vast amount of ignorance of the market. And if you're a trainer and you're so ignorant of the market, if you're a guru and you're so ignorant of the market, then I'm sorry for the people who follow you. So the next time you hear something in the Forex market, you hear people saying things, Google it, do research, find out whether they're making sense. Right? I'm not even talking about strategies. I'm talking about basic knowledge. Basic understanding of common things that we all should know, like how your broker works, what is a PIP, what is liquidity, how you put in orders. Those are basic stuff. I don't even do those stuff here. I just did this one because I'm like, this is really crazy. And it has thousands and thousands of views. Those are thousands of traders who have no idea what they're looking at. Because new traders, let's be honest, new traders don't do research. They just watch a video and they think, good, I've got it now. I know where the liquidity is. Another explanation the guy gave for it, which is pure nonsense, is he is saying that because the smart money, inverted comma, knows where retail traders put their stop, they're going to move the market up. Most retail traders will have their stop here. They're going to come take out the stops. And those stops is what is going to drive the market up. Now, that is so crazy. I don't even know where to start with that crazy stuff. First, retail traders, when you put a stop order, nobody sees it except your broker, because it's just an order that your broker is holding on to. So nobody except your broker know that you have an order that could be triggered. Your broker is not displaying that information anywhere. So he's the only one. Now, there are tens of thousands of brokers out there for any big money, any big market mover, and that would have to be a really huge bank that could actually move the market. They will have to spend hundreds of millions of dollars to move the market, maybe even more sometimes, to move the silver or gold or anything that much. They will have to spend a lot of money to move it that way, because you're selling, when you're selling, somebody's buying. They're not talking about your orders here, which your broker has in his hand, because that's not a sale, not until it gets triggered. And to move the market at that point, you don't know if there's another trader, if there's another, the Central Bank of China buying silver against you. Would you want to sell it to go take out 10 or 100 or 1,000 retail traders? That's like pure nonsense. And you would have to have all those retail traders on one broker which you're providing liquidity to. Because if you're Goldman Sachs and you're not providing liquidity to all these brokers, then you can't get their stops. You can't get those orders. Common sense will tell you can't get those orders. If you can move the market to wherever you want, but even if those orders get filled, they will not go to you unless you are the liquidity provider for all these retail traders. And I doubt whether Goldman Sachs is providing liquidity for all of you guys. And I doubt it. They might be providing for some huge brokers, but not all of them, and not the small brokers. So these are basic common sense. These are basic knowledge, I should say, that you can know. These are things you can research and you can know. But these guys are either too lazy or too stupid. Because when you see things like that, that's a display of ignorance, a display of laziness, right? Because you can actually do the research and find out. That's how I found out, by doing research, by understanding how the market works. The worst part of this is that I've seen some guys with like hundreds of thousands of followers, subscribers. One video had 355,000 views on it. And I'm like, that's 355,000 new traders who were misled on basic knowledge. I really don't get it. There is no liquidity sitting anywhere for you guys. There's nobody hunting your stop. Go watch the video I make, Why Stop Hunting, is pure nonsense. These are videos based on knowledge. They explain the market to you in details. The market moves like that all the time because orders are being filled. Let me explain to you easy, basic concept what happens. A market is a place where two traders agreed on a price but disagree on value. So if I want to buy yen and you want to sell yen, we have to agree on a price. This is the price we'll make the trade. I would be on the buy, you would be on the sell. Nobody's winning or losing. We just agreed that the value of yen is going to vary. The person who's selling the yen has no value for yen. Maybe he's leaving, maybe he needs dollar. That is why he's selling yen. And maybe I need yen, that's what I'm buying yen. We just disagreed on the value of it. Maybe I'm buying yen because I believe it was going to go, the dollar yen will drop and yen will gain value. Maybe it wouldn't. But the reason we make that transaction, both of us believe that at that price, we agreed to sell and buy, but we disagree on the value of things. That goes for your car. If you have a used car and you want to sell it because you need money, the guy who needs a car but has money will buy your car as long as you agreed on a price. When you leave, he'll be happy he has the car because he believes he got the car for a good price and it's going to save him a lot of money from transportation because now he has a car to drive. You believe you got a good deal because you got the cash that you so badly need and you have a car standing there that you're not using. So the value of the car to both of you are different, but the price that you agreed on is good. Both of you won. Nobody lost. It's not a zero-sum game. It's business. So when you make a transaction, the liquidity provider is not winning or losing. He doesn't know. He has made an agreement to take the trade, but he does not know whether he will win or lose that trade, and he doesn't care. Because on the bigger things of it, when all the trades are taken at the end of the day or at the end of the week or whatever, he still wins. 90% of you are going to lose. Because you have little idea of what you're doing. He has more idea what he's doing. He can hedge out some of those risks. He can pass some of those risks out on another broker or another bank. You don't do that. So he has more idea how he's running his business. So at the end of the day, he's going to win, you're going to lose. And his statistics have proven that 90% of you are going to lose and he's going to win. So, hey, he'll do the business. When the business starts going against him, he might stop doing it. Right? But as long as he's doing it, it's making him money. He's not thinking of being, like, I have to go hunt this guy. He's not hunting anybody. He's not hunting your stop. He doesn't care where your stop is. He doesn't care where your orders are. You can put or you can don't put. The market will not move towards your orders. The market moves toward real orders that are big by the big players. So if two banks want to trade currencies and they're trading in the millions, they will make an agreement and then the price will move from one place to the place where they agreed. So if the price of, if the price of yen is here, whatever that price is, and one bank called the other bank or one bank put an order out to buy yen, at the top here at a lower price, the other bank can decide, okay, I'll sell you at that price. Market will move towards that order. That is all there is to it. There is nobody trying to hunt you. You retail traders have to stop listening to these crazy, ignorant gurus who have no idea what they're talking about. Let them go study the market, because market moves with orders. When you see the market moving up and down like this, what it means is that the orders are being filled here. There is an agreement. There is an unspoken of agreement that once somebody is buying and somebody is selling that area, they've agreed to make all the transactions there. At some point, those transactions will break out either up or down, which means at some point, there will be more buy orders or more sell orders coming in. And that will move the market away from where they've all agreed that that's a good price. Why they've agreed? Because you put an order to buy, somebody sell. You put an order to sell, somebody buys. That means the price will stay where it is until it moves away from that zone, either up and down. It could probably move away and consolidate again, move away and consolidate again, move away and consolidate. That is because every time it moves into these zones, the buy and the sell orders are coming in almost equally. So, if it's going down, then you're having a little more of sell orders than the other. If it's going up, if it's going up like this, you're having a little more buy orders than sell orders. If it moves away really strong, that's big orders coming in to sell. If it moves up really strong, big orders coming to buy. That's all there is to understand how market moves. Now, the thing that you have to do as a trader is figure out when you see this consolidation, which way the market could move with a higher probability. Not with 100%, but with a higher probability. And that's what we do. That's called wave analysis. We look at the market and decide there's a higher probability for it to go up or for it to go down. And then we work on that probability. We try to take advantage of it. The market is going to break out, or here it's not going to break out. Sometimes it breaks out and it doesn't go. Because when it breaks out to the upside, there it hits a very huge sell orders and then it drops again. That's okay. That's called trade management. How do you get the hell out of that without losing a lot? Right? How do you manage the trade if it doesn't go to your target and you get out not losing a lot? That's trade management. This is all about knowledge, understanding the market, on having good strategies, having good trade management, using good money management, using good risk management calculation, and understanding all of that is based on knowledge. It's not based on somebody hunting you. It's not based on liquidity sitting somewhere and all of that nonsense. The reason they're telling you all those nonsense is because they have nothing of knowledge to share with you. The reason most of these guys are telling you all kinds of fancy thing and, conspiracy theories and all kinds of crazy stuff, kangaroo tales and all, is because they don't understand the market properly. They don't have the knowledge of what's happening in the market. And they're probably too lazy to do research. So what they do, they sell you crazy stuff. They sell you Procores, they sell you all kinds of nonsense that are basic. They sell you platinum, they sell you gold. Because you think you're buying gold and platinum and all of that stuff. And all you need to do is to learn to trade. So join us live. If you see this video today, you might be able to catch us in the New York session. If not, the 2 links are in the description. Go in the description, register. You still have 2 more days free. Click notification on my YouTube channel. Whenever I do these free sessions, you will not miss them. Right? I will be going live today on YouTube. So if this video is out before that, you will see it. If not, it will be after, so you wouldn't see it. You'll have to join us tomorrow morning, London session, 7:45 a.m. Join, come with all your questions. If you do not understand how the market is moving and you really, really want to get a little knowledge of how it works, join us. Come with the questions. We answer your questions. So with this, I'm going to leave you. I hope you know what liquidity is now, and you don't believe that nonsense that liquidity is sitting somewhere in the chart waiting for you. There's a liquidity pool at the bottom here. There's a liquidity pool at the bottom, or because the market moved this much, there's a liquidity gap. I think that's the funniest one. Because the market moved from one place to another, the guy said there's a liquidity gap there. I'm like, what? What the hell is he talking about? Like, what liquidity gap? What do you mean? They didn't have money from that place? The broker ran out of money from that point to that point? And if your broker ran out of money, that doesn't mean anything because the market moves without your broker anyway. Your broker is not an active participant in the market. I hope you guys understand this thing. Basic knowledge. There is only one secret to Forex trading. It's called knowledge. Educate yourself. Know what the market is doing. Knowledge is what's going to make you successful, not some secret sauce, not some conspiracy theory, not something about brokers hunting you, not something about liquidity gaps, not the nonsense you're hearing. Those would not make you successful traders. Knowledge of the market will make you successful traders. Join us. Thank you. Trade with care. Bye.